Welcome everyone to today's Associates meeting at the Stanford Institute for Economic Policy Research. I think most of you know me. I'm Mark Duggan, SIEPR's director, and I'm so glad that you could join us for our conversation today with Henry Fernandez, who will be talking about the transformation of the investment industry. This is our final Associates meeting of the academic year, and I want to thank all of you for attending today's event and for your continued support of SIEPR and your belief in our mission of catalyzing and promoting evidence-based knowledge about some of the most pressing economic policy issues in the US and around the world. Before we hear from Henry, I thought it would be nice to just quickly shine the light on some of the latest research by SIEPR scholars. So Hongbin Lee, who is one of our senior fellows, just had his analysis of the use of China's robots published, and industrial robots, published and featured in the Journal of Economic Perspectives. And two of our faculty fellows, Petra Persson and Maya Rawson-Slater, recently put out a working paper on the benefits of giving paid paternity leave to fathers. That research has received a ton of attention, and including it being the subject of a New York Times article just last week. So it is just a couple examples of some of the research that our faculty here are doing, and we have one other piece of business. So usually at our final Associates meeting of the year, we award what is called the Landau Prize, and that is given for the best SIEPR working paper submitted by a graduate student. But this year we decided none of the graduate students did a paper good enough, so no prize. No, I'm just kidding. No, but this prize is given as a tribute to Claire and Ralph Landau, who are both very dedicated to economic policy research. And this year, we're very proud to award the prize to Charles Hodgson. Charles is completing his PhD with us at Stanford. He'll be graduating this weekend, and he'll be starting as an assistant professor at Yale University in their economics department in the fall of 2020. But he'll first be spending the upcoming academic year there as a postdoctoral fellow. And his research interests are in industrial organization and applied microeconomics. The paper that won him the Landau Prize is titled Information Externalities, Free Riding and Optimal Exploration in the UK Oil Industry. I hear it as a real page turner. So Charles explores incentives faced by exploration companies, and I invite you to take a look at the paper, which is posted on our website. And usually I would now give the award to Charles, and we would take a photo and all that, but he emailed us 20 minutes ago that he had a family emergency and could not make it. So in any case, maybe we can just give an applause to Charles and for not being here for this. And we're sorry that he can't be here. But now let's switch gears to this afternoon's conversation with Henry Fernandez. Henry is the chairman and the CEO of MSCI. If you check out the company's website, you will see their purpose stated very clearly there. It is to bring greater transparency to financial markets, enabling the investment community to make better decisions for a better world. And who better than Henry to share with us some perspectives on how the investment industry is changing? Henry has been at the helm of MSCI for more than 20 years. The company has revenues of more than $1.4 billion, and it's listed on the New York Stock Exchange. And before becoming CEO, Henry was a managing director at Morgan Stanley, where he worked in emerging markets business strategy, equity derivatives sales and trading, mergers and acquisitions, mortgage-backed securities, and corporate finance. So a very diverse portfolio of areas. And before Morgan Stanley, he was president of the private equity firm Hispana Media, and he also founded Furco Partners, a private equity investment firm in Mexico. And it hasn't always been business for Henry. From 1976 to 1979, he was a diplomat in the Nicaraguan embassy in Washington, D.C. Henry has very close ties to Stanford. He received his MBA here, and he's on the university's board of trustees. And he's also, and I believe one of your children is a student, two of your children are students here, so that is great. So even more Stanford connections. He's also on the boards of the King Abdullah University of Science and Technology, Memorial Sloan Kettering Cancer Center, the Foreign Policy Association, and Catholic Charities of the Archdiocese of New York. And in addition to his MBA from Stanford, Henry has a BA in economics from Georgetown, and he pursued doctoral studies in economics at Princeton before being lured away by the excitement of Wall Street. So with that, please join me in welcoming Henry Fernandez to SIEPR.
Thank you, Mark.
Thanks so much.
Thank you, Mark. My mother will be extremely proud of that introduction. It's really a pleasure to be here and be with all of you. Stanford has meant so much to me and my family. We do have two of our sons. The oldest one graduated last year and is working in healthcare investment banking, living the dream to work in 20 hours a day. And my second son is a freshman, econ major, and taking his final exam in economics tomorrow. So I'm actually doing it remotely because he's doing an internship in equity research in New York City. So what I'd like to do is, before I get started, I'd like to introduce my good friend, Tony Chan, sitting here, baseball cap. Tony is the president of King Abdullah University of Science and Technology. It's a 10-year-old university, one of the best known in science and technology in the world, even though short life. And before that, Tony was the president of Hong Kong University of Science and Technology. And before that, he taught in a lot of different places, UCLA and other places. But more importantly, he's a graduate of Stanford, right? A PhD in computer science, right? Yeah. So thank you for being here. And he's visiting for a couple of days, and we were going to meet here, and he heard that I was going to be talking, so he wanted to come and check if I was telling the same thing that I tell everywhere else, right? So what I'd like to do is speak for 20, 25 minutes, and I'm going to try to give you a bird's eye view of what is happening in the investment industry. I'll try to be, wide, so to speak, as opposed to deep. Mark will take me down a little deeper, and then in the Q&A session, you can take us down even deeper in a specific area that you're interested in. And any and all questions are welcome. There's no politically incorrect question. So think about what you want to ask. So, and I'll try to be as layman as possible in what when I explain the investment industry, and I'll try to be a bit provocative so that we get the conversation going. So let's start with a big funnel, right? Let's start at the very top of the funnel and then narrow it down. There are a lot of changes. There are actually tectonic changes going on in the investment industry, but they're not happening overnight. They're happening year in and year out. So when you look at a 10-year horizon and going, 10-year history or 20-year history, you then see the enormous changes that are happening, and we'll talk about some of them today. But let's start with the basic component. There are increasing amount of savings in the world that are being professionally managed. And therefore, that is creating an enormous amount of capital in the world. That capital is being invested globally, more and more sophisticated. And part of this is clearly the institutionalization of capital through pension funds, sovereign wealth funds, endowments, foundations, family offices, and the like. But it's also unfortunately, the direct result of inequality, because there are enormous amount of wealth being created in the top sort of echelon of the world, particularly in places like in Asia. And all of that is finding its way to wealth management, and therefore there is an enormous amount of capital sort of flying around the world. Fortunately for us, so far, there are a lot of restrictions being put in place currently in the flow of trade, the flow of goods, and to some extent services in the world. And there's clearly a lot of restriction, being put in place in the flow of people, in the world through anti-immigration policies and things like that. But one thing that you don't hear much about, with a few exceptions, is restrictions on the flow of capital around the world. And it wasn't too long ago maybe 30 plus years ago, that there were a lot of restrictions on capital. Most people don't even remember that in the 80s, if you lived in Spain, a pretty big developed country, you could only take X amount of money, about, I think it was like $40,000, $50,000 a year out of Spain. Because there were exchange controls in a place like Spain. So a lot of the world today is capital is flowing freely. What that creates is that all this capital goes around looking for returns, and sometimes it creates bubbles because it goes into a particular area and a lot of money goes in there and it creates a bubble. But it's also create other areas that are left out. So if you were the finance minister of a country like Argentina today, it's a real headache to manage your country. Because it's depending on the value of the local currency versus the dollar and other hard currencies, and you get this money coming in and out all the time. I met with the Minister of Finance of Malaysia, and he was saying to me, "You're the culprit because you're creating a lot of this. You're the catalyst for creating this flow of capital coming in and out." I remember when we included Taiwan into the emerging market indices, the president of the central bank called me up to go meet with him in Taipei, and he was scolding me because he was saying that I was creating a problem for him because by the inclusion of Taiwan into the indices, a lot of money was going to come in and out, and it was going to mess up his undervalued currency, right? Because he wanted to keep exporting and the like. So anyhow, so you have that. Now, let's talk a little bit about what's happening. So that investment industry is becoming bigger and bigger and bigger every day. And most people focus on the banks in a country. Some people even focus on the life insurance companies. But when you really look at the world 50 years ago and look at the world today, where the big money is no longer in banks, not even in life insurance companies. Where the big money is, and increasingly so, is in investment institutions that have a longer-term perspective, than a loan that you can get, a short-term loan that you can get in a bank. So an example will be Canada today. If you look at all the assets in the pension fund industry in Canada, it's about $4 trillion. If you look at the total assets of the banks in Canada, it's $3.5 trillion. And the rate of growth of the pension fund assets in Canada is significantly faster. Actually, the banks can be even flat to down. So 10 years from now, you're going to see that amount of pension fund assets in Canada is going to be a lot bigger than the total assets sitting in banks. Even in America today, you ask, what is the biggest financial institution in America today? And most people will say it's JP Morgan, because the balance sheet of JP Morgan is about $3 trillion. Well, if you look at BlackRock, right, it's $6.5 trillion. Now, it's not depositor money, which is even better because deposit is investment money that gets turned into long-term capital by funding equity securities and bond or debt securities all over the world. So now, what I'm saying, therefore, to you is that the importance of the investment industry, broadly defined from the owners of the assets, the managers of the assets, and the traders of the assets, i.e. broker-dealers, is gathering more and more and more importance. I'll talk about MSCI and the role we play in that industry towards the end, but just bear with me and to understand that is a large industry and growing in all its components. Now, what are the trends that are happening in that industry? Let's sort of narrow the funnel. A lot of trends. We started with the first one, the globalization of investments. Every time you see a crisis somewhere and regulators are trying to go deep into it, you will see an incredible amount of globalization of money. During the financial crisis, there were many stories told about a little council sitting in New Zealand that went bust because they had invested in CLOs. And said, how could it possibly be that this small little place invested in CLOs? That's an example of how financial instruments are finding their way all over the world. So globalization of investing. What comes out of that is that the choices that institutional investors have today to invest in is massive, massive. In the 80s, in my early days at Morgan Stanley, I would go visit the GM pension plan, the IBM one, AT&T, and corporate pension plans at the time. And I would look at their portfolios, and they were pretty simple. They would largely own maybe 1,000 American companies, and they would own treasuries and corporate bonds. They would own real estate in the top 5, maybe 7 cities in America. Today, you go to CalPERS. They own the whole world. They own 10,000 public equities. They own, an incredible number of private equities. They own real estate in the top 700 cities in the world, and so on and so forth. The portfolio is massively global. So globalization is important, and the diversity of investment. Now, the third part of that is that if you are an institutional investor today, you have so much choice. Private asset classes, public, soft dollar, hard currency, and the like. So you have an amazing amount of opportunities to invest in. So the corollary to that is that if you are a country looking for money, if you are an issuer, it's a big fight to attract assets to come to you. So a lot of the role at MSCI, particularly through the equity indices, I go to countries and they want to be part of the equity indices, and we say, okay, show me, what is it how the market is structured? Can people buy and sell your securities? And they typically tell you, well, the market is closed right now, but we're opening up, and everyone is waiting for us to open up, and there is a line going around the world a few times over, waiting for you to open up, waiting for us to open up. And I, politely say, you know what? Nobody cares. Nobody cares. Even China, imagine me telling the Chinese government that they're opening up their domestic market, and they thought that there was a long line growing around the world waiting for them to open up. Well, not a lot of people care. So the amount of money that has gone into the domestic markets of China through the opening up process is really minuscule compared to the size of the country and the size of the economy. So that's creating, so the competition for capital in the world is more and more, brutal and more and a lot keener. So let's talk a little bit about, therefore, what are the investments, the process of investing taking place. That globalization that I talked about is also creating enormous complexity of portfolios. So if you're CalPERS and you want $350 billion in assets under management, and they run a lot of their whole portfolio on our tools, and on any given day, you want to know what the performance of the portfolio is, what the risk of the portfolio, what the correlations are. It's a nightmare. I mean, you own the whole world, so how are you going to understand the correlation, of all of this? And a lot of it is managed, all of it is managed through managers. Some of the managers have given them transparency of the underlying investments, particularly the public asset classes, public equity, public bonds. But they don't have a lot of transparency in the pool vehicles of investing, group investments in the private asset classes, private credit, private real estate, venture capital, and private equities and the like. So it's creating massive amount of complexity. For the asset managers that are managing those assets, is creating that complexity is creating also incredible needs for efficiency, because the cost of managing assets is too high relative to the returns, and is creating a lot of pressure for scalability. And that's why you see more and more asset managers merging, because they need to spread the cost of managing the assets over a wider base so that they can create more efficiency and scalability. So that's transforming the investment industry. So now let us take it down a little bit deeper and say, what are the kinds of investing that are being, that are transforming the nature of investing? So we talked about, obviously, global investing, particularly emerging market investing. Emerging markets are now about 12-13% of the total pool of available equity investments in the world, and continues to grow. I would imagine the next 10 years, that's going to be a quarter of the total investment opportunity set, because that's where the economic growth is. That's where the demographic growth is. And as Mark will tell you, economic growth, in simple terms, is a question of two things: is labor and the productivity of labor. So if you don't have a lot of labor because your economy is shrinking, like Japan, you may be a little bit productive, but no amount of productivity is going to make up for the lack of labor, and therefore your economy is likely to shrink over time. So if you go to India, you have plenty of labor and hopefully some productivity, so you're going to have a lot of great economic growth in India. You're going to have some in China, although that's going to disappear when the population starts shrinking. And in Brazil, hopefully you have economic growth. So emerging market investing is a big part of the world today. Another big area is risk-managed investing. I normally say that return and risk were not in the same table when people are making investment decisions. So we're trying to get risk be taken into account in the same way that performance, in order to be in the efficient frontier. That sounds like a very mundane technical issue. It's a huge issue, because what is happening in many of portfolios today is that they are taking very little risk. It's amazing, you will say, how crazy can that be? Most portfolios in the world of institutional investors are taking too little risk compared to what they could be to be in the efficient frontier return of a balance of return and risk. And a lot of it is because they don't understand the risk. It's not visible to them. They don't know how to manage it. They don't know how to measure it. And therefore, they become risk averse. They will do what is logical. So that's a big area. Another area of investing that is big nowadays, factor investing. Momentum, volatility, quality. This is a revolution going on. Some people call this smart beta. It's happening in equities. It's beginning to happen in fixed income. So that's a big trend in the world. Another big trend in the world, and this is probably music to the ears of this area, is private asset class investing. If you were to look at pension funds around the world and aggregate all their assets, they have about 14% of their assets allocated to private asset classes. And roughly, it is about half and half between private equities and private real estate, and a little bit of miscellaneous, but let's say roughly speaking. That amount of assets, and these are among the highest yielding assets. And venture capital, think of it as lumping it into private equities for now. These are high-yielding assets. That allocation should be a quarter, should be a third. But the problem is that the tools of understanding private asset class investing by large pension funds are too primitive. They don't have a lot of transparency on the investment. They don't have a lot of valuation. They don't have a lot of performance attribution models. They don't have a lot of risk models. But it is happening. So I envision that 10 years from now, the amount of assets, including individual investor assets, invested in private asset classes is going to explode. And you're already seeing it by a massive amount of money going into private equities. Large amounts of money going into private real estate. Think about this. Blackstone is the largest alternative investor or manager, right, in the world, alternative manager in the world. And they did it on the basis of incredible amount of private equity investing and a huge amount of real estate investing. And some private credit investing, some hedge fund investing, but private credit and hedge fund dwarf in comparison with the amount of money that they have. So Blackstone today is probably the largest investor in real estate in the world. Let me back up. Investor is the owner of the asset, the largest real estate manager in the world. So that's another. Lastly, and importantly, let me talk a little bit about, and then I'll talk about MSCI. Let me talk a little bit about a very fascinating area, which is sustainable investing. Sustainable investing is sometimes called ESG investing, or sometimes socially responsible investing, and the like. And MSCI is a leader in that. We call ESG investing. ESG is environmental, social, governance. the industry decided to be like a law firm. Instead of calling it something more understandable, put the name of all the things that you measure. You measure the governance of the company, you measure the social impact, and you measure the environmental impact of the particular company. But what it is sustainable investing. That is the fastest growing part of the investing world today. And what it is, and you're going to hear a lot about this, is very simple, is saying to Mark earlier, capitalism has a lot of things, a lot of definition, but most of the world runs in some form of free enterprise or capitalistic system. And what that is the bottom-up allocation of capital. That bottom-up allocation of capital, in order to be effective and efficient, needs a lot of information about how do you price assets, and therefore how you allocate assets. And we have an enormous amount of financial information to figure out how to price assets and allocate assets. But what we don't have is a meaningful amount of non-financial information about those companies, meaning how do they operate in terms of their government, so to speak, their governance. Are they responsible with respect to the environment? Are they polluting the environment? Are they polluting rivers or the like? And the social issues, which are very prevalent today. Do they have a hostile environment to work at? Do they discriminate against certain type of people in the work environment, and so on and so forth? So society nowadays, because of the large amount of information available about those companies and what they're doing, is becoming highly intolerant of a lot of these issues. So those companies are getting hit. Think of Uber as an example, right? Private company, but still, who would have thought 10 years ago that a private company founded by an entrepreneur creates a hostile work environment? There is a lot of things that are going on there, and the board of directors kicks out the founder. That would not have happened 5 years ago, 10 years ago, would not have happened. So, I normally tell people in academia that every month that goes by, there is a university president that resigns because of some social issues, that are happening on their campus. So anyhow, this is an area that the world is pushing really hard. Institutional investors around the world say, I want my portfolio to last for a long time, 10 years, 20 years, 30 years, and therefore I'm going to hold companies and bond issuers to a higher standard of governing, their entities, the climate change, the issues of climate change or environmental issues and also social issues in order to create a cohesive society. Because if not, the value of those securities are going to come down. So this is growing by leaps and bounds. It's the fastest growing part in our company, for example. So that's another part of the investing. Lastly, let me talk about passive investing, index investing. And I like to talk about it. I said that the global investment industry is growing by leaps and bounds, but there are pockets of that industry or areas of that industry that are very challenged. Stock picking, what is called active management, is being enormously challenged. A lot of money is coming out of mutual funds that are picking, the managers are picking stocks, and they're going into indexed or passively managed funds, in ETF, for example, but also in mutual funds. So, passive investing is revolutionizing, the investing industry, quite a lot, because it's when the more markets become semi-efficient, it is a lot harder for humans, to pick stocks and create value relative to a basket of securities called an index. So that is creating enormous pressure on the business model of active managers, and is creating a large industry, which we call passive management or index investing. And but there is a lot of competition in that industry, and the fees are coming down. If you think that your ETF is low cost, well, 5 years from now, 10 years from now, it's going to be even much lower cost, than that. It's creating a lot of competition on that. So that's another revolution that is happening. Now, why do we care about all of this stuff? I go back to the fundamental principle at the beginning. The prosperity, economic prosperity in the world is more and more dependent on, clearly, production, internal production of services in an economy, goods and services and the like, but it is the money that funds that. And the question is, where is the money coming from? So obviously it's coming from savings, from individuals and companies and governments, coming from savings, but who is managing those savings? More and more and more today, those savings are being managed by investment institutions and not banks and not life insurance companies. And therefore, and normally it's the old adage that you said, two people want to go steal money, and one asks the other, where do we go to steal money? And the other, of course, we go to a bank, right? That's where the money is. That's where we're going to steal money. Well, nowadays it's not the banks, it's the investment institutions of the world that are becoming, bigger and bigger and bigger, and are creating, enormous availability of capital. So on MSCI, what MSCI is Mark said it, is very simply a company that helps global investors build better portfolios. And what we do, we don't manage assets. We're not an advisor. We're not a broker-dealer. We're not a bank. None of that. What we do is we provide all the tools necessary for a lot of these institutions to do their job. That industry, investment industry that I talked about, that it is growing and is attracting among the best and the brightest in a society. Think about the venture capital industry here in the Valley. It's attracting a lot of the best and the brightest in a society. If you think about hedge funds, if you think about asset managers in London, London is largely a service economy of asset management. And the clearing process and the trading processes and the banking processes and all of that. So when those people show up to that industry, the tools of the trade are very primitive. And what MSCI's mission is to bring a lot of those tools to the 21st century. What are they? Equity indices, risk management, risk factors, risk management tools, portfolio management tool, asset allocation tool, portfolio construction tools, et cetera, et cetera. So I don't want to bother you with that, but that's the reason I mentioned that is because we have a front row seat into what is happening in the global investing industry, because we're a research-driven think tank kind of company, and therefore the largest asset managers in the world, the largest asset owners in the world, the biggest banks, they come to us and say, have you built a model for this? Have you thought about this? What are your clients doing in this area or that other area? And therefore, it gives us an enormous window into what's happening in this industry. And that's a lot of what I was telling you about. Let me pause there and turn it to Mark.
Okay, great. Thanks so much, Henry.
Yeah.
That's great. So I just have 2 or 3 questions, then we'll open it up for the audience. So one thing that we talked a little bit about earlier, and that I wondered if you could just share with the audience here a bit, is just give us a sense of the founding of MSCI. It happened about a little over 20 years ago, I believe, and what your role was in it, and what was the unmet need that you were filling then, and sort of challenges along the way, and so forth.
So, I came to business school here in the early 80s, and I think what happened then is also true now, is, a lot of my classmates, if you were not an entrepreneur trying to create something or invent something, you were no one, right? And so I came out of business school with a big entrepreneurial bug, and but in those days, compared to today, it was extremely hard to sort of hang your shingles and say, I'm an entrepreneur, I'm going to build something. It was extremely hard compared to today. I mean, today is still hard, but there were a lot fewer people in those days. So I went to Wall Street with a view that I would learn how to work, right? Build a little bit of resume, and then set up to invent something or buy something. So I tried 3 or 4 times, and I failed. Some of the names that you listed, my private equity firms and the like that I did. And but eventually I went back, so I was at Morgan Stanley, left and came back, and I found this little cost center within Morgan Stanley that was creating these equity indices, and it was a joint venture between Morgan Stanley and the Capital Group of Los Angeles. Capital Research, Capital Guardian, Capital International. That's a CI in MSCI, right? So, so I said, instead of being an entrepreneur, why don't I become an intrapreneur? So I left, I had a day job. I did this for a night job for 3 years, and then I decided to go full time. And everyone thought that I was crazy, right? Because the thing was in the backwaters. Not even the backwaters. Nobody even understood what we did. So, so that's how I started, and it was losing a lot of money. And I went to my bosses at Morgan Stanley, and I told them, you got to figure out how to pay me. And I said, I don't know how we're going to pay you. So I said, that's your problem, right? So I'll go do this. And I moved to Geneva, Switzerland, because that was the headquarters of the business at the time. The need that I saw was exactly what we are doing today, except that at the time, I only saw it in the equity investment industry. And the need that I saw was, look, this equity investing thing is growing. There are a lot of people investing globally, emerging markets, developed markets, all over the world. Those were the early days of global investing in equities. And I said, and they don't have a lot of the tools. They don't have indices. They don't have risk models. They don't have portfolio construction. So that's how I started. And then once we got the company to break even, then I bought a company called Barra here in Berkeley, made up of a lot of Berkeley people. So they saw me as the enemy sometimes, right? Stanford person. And then we incorporated risk and return in equities. The equity indices were the performance thing, so to speak. And Barra risk models were the risk thing. And we kind of combined it to build factor indices and things like that. And then it sort of, then after that, we went into multi-asset class with the acquisition of Riskmetrics, which was the original value at risk engine of JP Morgan, that they created the risk industry, right, basically. And then we bought a lot of other things, and eventually Morgan Stanley, believe it or not, kicked us out. At the time, I didn't want to leave, but they said, no, you got to leave. So we went public at $18 a share 11 years ago, and today we're trading at $240 a share, so it hasn't been bad.
Right. So you mentioned a little bit emerging markets, and I wonder if you can share with us a bit the process. So China was added to your emerging markets index. How long ago was it now? Like
a year plus ago.
Okay, so pretty recently.
The first leg was last year, and then the second leg is starting. The second phase is starting this year.
Yeah. So can you share with us a bit, sort of your calculus on deciding whether to add them, when to add them, and how big a share? Because when I look at it, looks like from a naive analysis of some of the numbers that I saw on the website, is that they have a 3.3% share of the index, which seems small, but then it's misleadingly small in some ways. Can you share with us, though, a bit the China decision?
Yeah, so without trying to exaggerate here, the biggest economic event of our generation has been the incorporation of China's real economy into the global economy. You cannot underestimate the massive change that has taken place in the economy of the world by that. You could also say, is the incorporation of India's service economy into the global economy in terms of the call centers and software design and things like that. But it all started with China. That has been a massive change in the global economy. One of the biggest events of also our generation, but the future generation, is going to be the incorporation of China's financial markets into the global financial markets. China has the second largest equity market in the world today, the third largest bond market in the world today, and is relatively closed. Not totally, but relatively closed. It's a hassle to come in and out and invest. So it's not very fungible. So think about this. if you were a bond investor today and you want to invest in a 10-year bond, you have the U.S. Treasury bond at 2.17%. You get the German 10-year bond at minus 23, 25 basis points. You got the Japanese JGBs, government bonds, at minus 13 basis points or something like that. And then you got the China sovereign 10-year bond at 3.25%, backed by $3 trillion of reserves. If these markets were fungible, where would you put your money? Right? Would you put your money? Particularly in a day and age of everyone searching for yield. What is happening, though, is that those markets are not totally fungible. They're far from being fungible. They're far from being open. So, and thankfully, they're not completely open today, because if they were suddenly open, there will be a big realignment of supply and demand. There will be a lot of treasuries sold, a lot of German 10-year bonds sold to buy the Chinese one. And in the equity world, there will be a large amount of particularly emerging market equities sold, sort of Indonesian, Russian, Brazilian, Mexican, Turkish, Korea, Taiwan, India, sold in order to make room for this whale coming into the swimming pool, which is, the domestic markets of China. So fortunately, it's going at a fairly measured pace. And the like. So today, if you look at the MSCI Emerging Market Index, which is the benchmark of the 99% of the world that invests in emerging market equities, is actually 32% Chinese already. Now, it's made up of two types of China. The Chinese companies that are listed outside of China because they wanted to attract sort of global capital. So Alibaba is listed in New York Stock Exchange. Baidu, Tencent, China Mobile and other companies like that are listed in the Hong Kong exchange, but they're freely tradable. You can go buy and sell them anytime you want. That is about, let's say 30% of the index today. The domestic, that's not the one that I'm talking about, the second largest market. The domestic market of China is called the A-share market. A as an apple, A-share market. That is huge. It's got a lot of companies, very diverse. Some of them are state-owned companies, some are technology companies, some are consumer companies, a lot of different companies. That if we were to incorporate all of that, a domestic market of China, into the MSCI Emerging Market Index, which if you are passively running money, you're going to have to replicate, the weight of China in the index will be 45% already. And counting. Right now it's a little bit of depressed because of the trade wars and all of that and the economy. But 10 years from now, the growth of China will continue. It will outpace other emerging markets. So you could have, a time in which China is 60% of the emerging market index. That's a massive change. And if it were, as I said, totally fungible, you got to sell a lot of other assets in the world. Remember what I said? Go back to what I said at the beginning. You go to a country like, the smart countries, like the smart countries, particularly in Asia, they see this coming already. And they say, we might as well become more attractive to foreign investors because otherwise we're going to get crowded out by China.
Interesting. So, yeah, so 45% is a lot bigger than 3.3%.
Yeah.
It sounds
because most people focus on the new thing that is coming.
Right. So one area of the world that we haven't talked much about is the Middle East. And my understanding is that you know the Crown Prince of Saudi Arabia. And I'm wondering if you can talk a little bit about how you came to know him and how that relationship has evolved in recent times.
Yeah. So the Crown Prince of Saudi Arabia, Mohammed bin Salman, is a lot of issues, right? But think about the other part. He is a really modernizing force in the Middle East. He wants to turn his country into a shining example of prosperity in a region of the world that hasn't seen a lot of prosperity, for a long time. And he's using his power, autocratic rule. He's using his money, oil money, to try to turn Saudi Arabia into a dynamo of investing. At his heart, the Crown Prince is an investor more than a politician, more like diplomat or anything like that, right? So clearly is an autocratic regime, clearly is an absolute monarchy and all the repercussions associated with that. So, so when he came to power, the process was already there, but he wanted to open up the country. He said, why can foreign capital not come in and out at their will here? So they call us up to see how we could help, not advising them. We get paid by the investors, in the world. We don't ever get paid by the countries or any. But they said, look, if we wanted to be part of the indices, which are gatekeepers, especially clearly the emerging market index, what is it that we need to do? What conditions do we need to meet in the country to do that? So he called me, can we meet? So he went through a half an hour discussion of what he wanted to do with the country and all of that. And then I told him what they needed to do. And he turned to his finance people and I said, what is this thing about emerging markets? Why don't we bypass all of that? Why don't we do everything that they want in order to become a developed market? And you can imagine all the finance people say, wait a minute, there's a lot of things that need to happen to become a developed market, right, in the criteria of MSCI. So they have been, the sort of government itself have been the best at following everything that global investors wanted them to do to open up the market. They wanted, this is the settlement system, this is the laws, these are, the trading and all of that. So that's what's happening. So the country, we're soon launching index futures. There's no such thing as index futures in the Middle East. We're launching index futures at the end of the year, hopefully. They're launching, exchange traded funds in the country. They're trying to set up structured products and all of that. So it's a big modernizing force in the context, obviously, an autocratic regime. So a lot of capital is flowing in. Obviously, oil prices are low, so they still have a big deficit in the budget and all of that. So it's a very exciting part. And if they pull the thing through and are able to, again, we're not talking about the political system or the governance of the country. We're talking about economics and investments, right? But if they're able to do this, they for sure can become a great example to other countries in the region. And what is happening now is because of that force of Saudi Arabia, the other Gulf countries, the Emirates, Kuwait, Qatar, which is they have this fight going on, and all of that, they're calling us to say, gee, can we do better than that? Can we open up better? So, for example, Kuwait right now is on the watch list to be promoted from a frontier market to emerging market. And, they call us up and say, oh, we're doing this better than the Saudis. We're doing this better than the Saudis, And so there is a good, virtuous circle of more reform, competing with one another in order to create better and better conditions for global investors to go invest in their countries.
That's great. Okay, great. So I want to open it up now for some questions. I'm on it. For some questions from the audience. So let's see if anyone here has. I have plenty of questions that I can ask. But right back here. Yep.
Hello. Quick question. What about the transformation on the industry coming from all the disruption through robo-advisors and artificial intelligence? How are you guys implementing? How is this affecting the industry moving forward?
So thanks for that question. What I didn't cover, given the short amount of time, is the following. The global investment industry is ripe for major disruption. It is one of the most salient industries in the world that throws an incredible amount of data. I mean, we cannot have investments without data. And if you're going back to the CalPERS example, right? Imagine the data that they have in their portfolio. They own everything. So they have a massive amount of data. They need a lot of analytical tools to understand the data, understand the return of the investment, the risk of the investment, and they need a lot of technology to be able to manage all of that in an efficient way. So they can do asset allocation, they can do portfolio construction, they can monitor the managers, they do, et cetera. So this is an industry which should be a classic poster child of innovation. Because if you think about what are the big things going on in the world, is how do we manage big data? How do we create analytical tools to understand data, right? So a self-driving car has a lot of data, and there is an algorithm that is telling them, don't go there, go here, that kind of thing. That's an analytical tool, right? So when you go to Amazon and they tell you, oh, you've just bought this, why don't you buy this? That's an analytical tool, right? That's an example. And then obviously, lastly, a huge amount of technology, including machine learning, artificial intelligence, and all that. That's one layer. The other layer is an industry that has an incredible amount of humans in it. And given the world of lower returns that we're living in, the cost of managing assets in the world is too high for the gross returns that we're getting. So I would venture to say that half of the cost of the asset management industry needs to be wiped out. So how are you going to do that? You're not going to do that by hiring more humans. Yeah, you need to have more machines that are helping the humans, right? So that's where a lot of this things. So robo-advisor, as an example, is an investment and asset allocation tool. It is made possible because you can combine a lot of baskets of investments. So a lot of robo-advisors are sort of predicated on ETF, because you can now have every ETF in the world, and therefore you have a robo-advisor that creates an asset allocation based on all those ETFs, and you can create an instant democratized portfolio. You could have $5,000, right? And have a global portfolio of public securities, not private, but public securities. So that is a major innovation that is taking place. And I think it will, most people will laugh at this, but there will be robo-advisors and institutional investors at some point. There will be a pension fund that will have a robo-advisor. They just don't know it yet, but that will happen there. So, but again, this is the role that MSCI wants to play, which is we handle massive amounts of data. We're an analytical company, and we're a technology company. So we're trying to bring that industry. We're on one hand disruptors of all of our clients. On the other hand, we go there, we disrupted you. Now we need to help you. So,
Jeanette.
I did not anticipate asking you the question I'm going to ask, but you spent a lot of time talking about alternatives. And so everything you've just said about how the industry has changed in bringing transparency into the public markets, it's music to an economist's ear, right? The more information, the more transparency, the better decision making. But you did emphasize a lot about alternatives, and that's the least transparent and highest cost area of the business. Very difficult to ascertain the risks, very difficult to ascertain the fees, whether one's talking about private equity or anything else. What revolution do you anticipate seeing there that will enable better decision making?
Going back to CalPERS, and I use CalPERS a lot because they allow us to talk about them, right? And it's public. 15% of the assets at CalPERS are in private asset classes, and they pay 80% of the fees. So when you look at all the fees that CalPERS pays for managers, 80% of them go to pay for 15% of the assets. Private asset classes, right? Mostly private equity and private real estate. And so we at MSCI have recognized that as an example, and we want to create what we call the MSCI of the private asset classes, which is how do we bring transparency? How do we bring tools to understand the investments, the risk of the investment, the performance of the investment, so we can bring the cost down to begin with. That information, people don't trade on hogging information. It's available to a lot of people. and it will facilitate more allocation of assets to the private asset classes. So it's hard because what our industry, meaning the industry that supplies tools, is created is on the basis of a massive amount of public information. And in order to do what we do, we need two things always. We need to understand the investment, and we need to price the investment. Once you understand the investment and price the investment, you could build an incredible amount of things on top. You can build indices, you can build performance attribution models, you can build risk models, you can create price, asset allocation models, and all of that. So what we do is, in the public asset classes, it's difficult, but it's not that difficult relative to the private. We go to all the massive amount of public information available. So we know what public companies do because they're public. They got to register with a securities commission somewhere in the world. We know what the prices are because the prices are either listed in an exchange or they're trading in an over-the-counter market with a broker-dealer. So we can pick those prices, and then we can build everything. In the private asset classes, you don't even know what the investment is. You don't know what the private company does, and that's the easy part. The more difficult part, how's going to price that? So we have already entered in that with real estate. We have about $2 trillion worth of information. We have information on about $2 trillion of real estate assets in the world, in which we know exactly what the property is, and we know how to price the property. We're trying to do that into private equities. Right? The industry, the managers, the asset allocators love you because they're the owners of the asset. The managers fight you tooth and nail. Actually, I went to one of the biggest sovereign wealth funds in the world, and I had right in front of me the head of asset allocation and the head of real estate investing. And the asset allocator says, Henry, we need more transparency into the real estate markets in the world so I can understand better, so I can move money around more easily. And right in front of his eyes, the guy who runs the internal real estate portfolio says to him, I hate this fellow. I hate him because I am the largest sovereign wealth fund in the world. I have more information about real estate assets, where the returns are, where the risks are, than anybody else. He wants to spoil my whole party because he wants to make that transparent. Imagine what he's trying to do. I cannot charge the fees that I charge because, that. So, but we're going to break them down. This happened in the high yield market when we started building fixed income indices at Morgan Stanley. The high yield desk hated me because they were taking 2-3 points, bid-ask spread points in high yield. And they said, you're going to make that transparent? It's going to collapse to 20 basis points, half a basis point. I won't be able to take 3 or 4 points, 3 or 4%, right, between the bid-ask the ask on this. So that, that fight, they lost it. And, the hedge funds will say, I don't want to provide you my information because it's a secret sauce, secret recipe. Well, there are very few hedge funds today that do not provide you their information.
Okay, well, we are a couple minutes over, so I think we should wrap up there. If you have questions, you can come up after, but please join me in thanking Henry Fernandez.